You've probably seen the headlines. Big names like Citi, Barclays, they're selling off their retail businesses in India. Now, in an economy that's booming, that just sounds weird, right? But what's really going on? Let's get into it, because the real story is way more strategic than you might think.
So what's the deal? Are these massive global banks actually fleeing India? I mean, from the outside, it kind of looks that way, right? But if you dig just a little bit deeper, you realize it's not a retreat. It's more like a strategic realignment. Yeah, and that's the key thing to understand here. This isn't a story about failure or some kind of crisis. It's a really calculated strategic pivot. These banks aren't running scared. They're just refocusing on what they're truly good at and adapting to some pretty major shifts in the Indian market. Okay, so first things first, we need to be clear about what leaving even means in this context. They're not packing up and leaving India entirely, not even close. They're just stepping back from one very specific area, retail banking. You know, the everyday stuff for you and me, savings accounts, credit cards, personal loans. In fact, in other areas, they're actually doubling down. So why this part of the business? Why retail? Well, it all boils down to one simple, powerful idea. In India, retail banking is a game of scale. And in that game, the local players, they have a massive home field advantage. And this slide right here, it just lays out the problem perfectly. I mean, take Citi. Before they sold to Axis Bank, they had just 35 branches in the whole country. 35! Axis Bank has over 4,500. Now, this isn't just about being able to find an ATM. It's about the cost of money. Domestic banks use that huge network to gather billions in low-cost deposits from savings accounts. Foreign banks, with their tiny footprint, have to borrow money at a higher cost to give out loans. That squeezes their profit margins right from the get-go.
And that one problem creates this whole domino effect of challenges. See, to make real money in retail, you need massive volume, which they just don't have. They're up against fierce competition from Indian banks that, let's be honest, now offer service that's just as good, if not better. And then you've got the regulations that force them to lock up a lot of capital in India for returns that are, well, often lower than what they could get somewhere else. It's just a really tough equation to make work.
And you can see here how different banks are reacting to this reality. But the logic behind it is exactly the same. Citi just made a clean break, selling its whole consumer business to Access. HSBC, on the other hand, is doubling down, but only on the super wealthy. That's a niche where their global brand really gives them an edge. And then you have Standard Chartered, which is just shrinking its mass market loans to focus on its other strengths. So you see, it's all about playing to your strengths, not some kind of verdict on the Indian market itself. Okay, so if the scale game was the underlying condition, then one single thing came along and acted like a massive catalyst, speeding this whole trend up. And that was the arrival of UPI, India's Unified Payments Interface. It didn't just change the game, it completely rewrote the rulebook. Think about it. Before 2016, if you wanted to pay for something without cash, you probably pulled out a credit card. And foreign banks were the absolute kings of credit cards. They had the best tech, the best rewards programs. This was their profit engine. But then UPI launched. And today, for pretty much all of your daily payments, from your morning chai to your groceries, UPI is king. Is that simple? So how exactly did UPI manage to do this? Well, it was a direct attack on the very heart of the credit card business model. You can see it right here. Credit cards make money in three main ways. First, there are interchange fees, that little 1–2% that merchants have to pay on every single transaction. UPI made that zero for most merchants. Poof, gone. Second, there's the interest on revolving credit. But since UPI is linked directly to your bank account, that revenue stream just shrinks. And finally, you've got annual fees. It's pretty hard to convince someone to pay a fee when there's a fantastic alternative that's completely free. And all of this created a fundamental mismatch. The foreign banks were built on this model of high rewards and pretty expensive servicing, all paid for by those card revenues. The new reality in India is an ecosystem built on ultra-low costs, massive volume, and the expectation that payments should be free. Their business model just wasn't built for this new world. And this quote, it just says it all, doesn't it? UPI did not kill banking. It killed the foreign credit card-led retail strategy. UPI didn't hurt banking at all. In fact, it supercharged it. But what it did kill was that very specific credit card-focused strategy that was the absolute cornerstone for how most foreign banks operated their retail businesses in India. All right, so that's the why of it. But what does all of this actually mean for you, the average customer, and for the Indian banking system as a whole? Let's break down the impacts. You know, for most people, the change has been pretty seamless, maybe even a positive one. I mean, when an account moved from Citi to Access, for example, those customers suddenly got access to a way bigger ATM and branch network. For probably 95% of users, the experience is just as good, if not a little bit better. Sure, a small group might miss some of those niche global services, but for most, it's been a really smooth transition. And what about the Indian banks? Oh, this has been a huge win for them. They're not just buying a list of customers, they're acquiring a really high-quality client base, a workforce that's already trained, and really sophisticated global processes. Like, by buying Citi's business, Axis Bank got all three of those things and instantly became one of the top credit card issuers in the entire country. This is how you create stronger domestic champions. So what you're seeing is this consolidation leading to a more stable, more resilient financial system. The big decisions are being made locally now, and the whole sector is much more in tune with India's unique digital infrastructure, like UPI. Most experts really see this as a natural and, frankly, a healthy evolution for the market. So that brings us to the future. If they're getting out of retail, what exactly are these global banks going to do in India? Are they just giving up? No, not at all. Their strategy is actually crystal clear. They're getting out of the mass market retail game because, like we said, it's all about scale. But they are absolutely doubling down in areas where they have a true global advantage. Things like helping large Indian companies raise money overseas, financing international trade, and managing the wealth of really high net worth individuals. They're not quitting. They're just playing a different game now, one where their global network is their biggest asset. Look, if you take away just one thing from all of this, let it be this right here. This was never about foreign banks being bad at banking. It's about recognizing that retail banking in India is a scale game. And it's a game that the local banks, with their massive networks and low-cost funds, have already won. And that leaves us with one final, really important question to think about. As the market consolidates and these global players step back from the retail fight, will India's newly beefed-up domestic banking champions keep innovating at the same incredible pace? Or could less competition lead to complacency? Well, that's the next chapter in this fascinating story. Thanks for joining me.